Hey, good afternoon, everyone. Marty Missouri here. It is the 4th of March, 2025, Tuesday, with your midweek market update. It's about a half hour before the market closes, and I thought I'd just jump in while I had the chance. Today, as opposed to tomorrow, although I do a lot of Tuesdays and post to you on Wednesday, which is going to happen now. But anyway, just because of the incredible volatility we've been seeing of late. Now, clients, and I'm sure regular watchers of the videos and readers of the blog, I know I've said it on here as well, but I've been saying it to clients that this is going to be a most challenging year and expect lots of volatility. I showed you my kind of market EKG. I don't have it dialed up for today that shows the daily rate of change and how we're getting the kind of movement above and below certain bands that I placed as percentages moves on a daily basis that looks like the kind of vibrations that tend to shake things loose historically, and we're seeing a lot of that of late. In fact, when I decided to shoot the video and lined up the graphs that I want to show you and gave a little thought to it, which was just a few minutes ago, stocks were in the green. The S&P was up about 15 or 20 basis points, and the NASDAQ is up. I think it's still up a little bit, but the Dow was still down about 200 points. And within the no more than 10 minutes that it took me to line up the charts, the S&P is now down 0.5%. The Dow is now down 400 points, and the NASDAQ 100 is giving up about half of its gain that it had just a few minutes ago. So I want to speak to the technicals because I think today's action is just largely the result of technical traders. There was a little bit of news that seemed to provide a bit of a floor for a moment. And who knows, maybe in the next half hour, the market will come screaming back into the green. We shall see, but that's the kind of short-term stuff that we pay attention to, decipher, if you will, but not react to as long-term thinking money managers. Okay, so let's just start with my own commentary. Take a lot of notes internally, things that I can refer back to. I call it our market log. Been doing this for a long, long time, and within the last year or so, it's been an easy place for me to reference for these commentaries. So I want to focus on Europe for a minute because Europe has been interesting to us for a while now as a potential decent size weighting among our equity exposure. And the reasons being multiple, partly because they seem to be at different stages in the economic cycle. They have been in recession for some time now, while the U.S. remains not in recession. And the valuations are historically wide, meaning European stocks are historically cheap relative to U.S. stocks. And to add more strength to maybe a longer-term bull case, Europe appears, at least rhetorically so far, and maybe more than just rhetorically, has woken up to the need to become more capital friendly in their economy from a number of fronts. And it's commentary from the ECB, the recent German elections and so forth, and that has provided a boost to European equities, which have been a not small reason why our core portfolio has done so well this year relative to the U.S. equity market. But again, I've been telling clients we are not taking anything for granted. The year is barely 2 months old, and there is much to come. Again, the Eurozone is interesting and compelling in many ways, but we did put some protection underneath it because we've had such a good run already this year. And we are skeptical that when tariffs are implemented, which right now would be the reciprocal tariffs that the president has talked about that would begin in April. If nothing gets in the way of that, that can become problematic for what has been a nice setup and a nice run so far this year for European equities. To begin with, and this came from Bespoke Investment Group's morning notes this morning, European unemployment across the EU as a whole at 6.2%. Unemployment rate for January remains at a record low, and the 6-month change in that unemployment rate remains negative. While Germany is still underperforming the European labor markets writ large, deterioration may be over for now, given the turnaround in the cyclical data and the prospects of much more aggressive fiscal activity. That's what I was more or less alluding to, especially on the defense front. So just a chart of German unemployment, right? And then I pulled up our own economic surprise indexes for Europe. And so this is data as it comes out relative to economists' expectations. It's at a positive 29. Anything below zero means that the data is coming in notably worse than what economists had anticipated. And that's where we are in the U.S. at a negative 16. So contrast the latest in terms of data relative to expectations. I mentioned valuations, the U.S. price to earnings ratio at like 25 times earnings versus the Eurozone at like 15 times earnings. That is a massive gap. And here's a 5-year chart. And you can see they tend to run closer together. So again, there is either a lot of potential catch-up for Eurozone equities or catch down for U.S. equities from a valuation standpoint, or meeting somewhere in the middle. With regard to the topic of the day, of course, tariffs. This is Peter Bookvar pulling from the Institute for Supply Management Manufacturing survey, which came out yesterday, and it's a component in our own economic index. He talks about the 2018-19 tariff battle that did put the U.S. manufacturing space into recession and did lead to Fed rate cuts in 2019, just as the sector was actually showing signs of bottoming. So they always feature 10 comments from their respondents to the survey. And in the chemical products industry, the tariff environment regarding products from Mexico and Canada has created uncertainty and volatility. From transportation equipment, customers are pausing new orders as a result of uncertainty around tariffs. From the machinery sector, incoming tariffs are causing our products to increase in price. From electronic equipment, appliances, and components, the uncertainty about tariffs is keeping us cautious on spending. From non-metallic mineral products, management now has us running scenarios to project tariff impacts on our business. Plastic and rubber products, general business conditions remain tepid. Outlook on the durable side, growing more pessimistic. And then primary metals, customers are still very hesitant to commit to long-term volumes due to market uncertainty caused by proposed tariffs. So yes, it's an issue. No ifs, ands, or buts about it. And we'll talk about our view of how it's impacting important markets. Again, in terms of Europe, European PMIs came out. My own note is I concur with the highlight below, although tariff risk remains high. And the highlight is that the PMI for Europe, Purchasing Managers Index, hints that manufacturing sector may be finally finding its footing. New orders are falling at the slowest pace since May of 2022, and production is edging closer to stabilizing. So after almost 3 years of recession, we could see a bit of growth in the coming months. Now, you might say, well, that's not growth. No, it's not. But what you look for to anticipate is you look for a bottoming in the data or a slower rate of change as it continues to go. That's a sign. You need to start thinking in the opposite direction. Yes, unequivocally, this clearly is the problem for the equity market here the last week or three. Keep in mind, folks, that the U.S. market is sitting at valuations by some metrics we haven't seen other than like 2 points in history, 1929 and 1999. Now, what we've seen of late is the market can react violently in the other direction as tariffs are delayed, taken off the table, and so forth. I think I can be so bold as to say, make no mistake, the Canadian and Mexican tariffs are very likely to be short-lived. Those are huge, as would be the retaliatory tariffs. Trade wars with our closest key neighbors would not be in anybody's best interest at all. And the markets, if this became clear that it's a longer-term campaign or endeavor, there's your bear market, I think. And we may get it anyway, but I will be blown away if they let the tariff war between those two neighbors get out of control or not get contained relatively soon. Okay, so wanted to make this one kind of quick. There's so much more I could talk about, but I think that gets to the key points that were on my mind. Let's take a look at some charts really quick. So today what we've seen, although the market's rolling back over, the Dow's down 500 points, the S&P is down 80 basis points, and the NASDAQ's about to go back into negative territory. But as we bounced, I was watching this and honestly kind of anticipated it. And that is that this 200-day moving average is not going to go easy, right? Here is the S&P. Remember I said up in here, I didn't see a lot of support between there and the 200-day moving average. We did live on this support line for 3 days, and then boom, and today bounced pretty strongly above it. This is a delayed chart, so this candle body is moving its way back down. Right now, the S&P is at 58.02, and it was at 58.27, or that's where it is on this chart currently. Remember that up in here, I showed you on the weekly chart, a weekly bearish engulfing candle. And up in here, I said you tend to get more of a decline than what we've had so far. Now we're talking in terms of at least the minimum that we should see, technically speaking. But today's bounce makes perfect sense, right? Notice how, we came and bounced off the 50-day moving average, lost it. You see how long the market battled with the 50 before it really pretty much resoundingly, and now it's becoming resistance. So if we were to get a big move, I mean, swing traders would probably short the S&P right here at the green line if we actually got that much of a move. So here we are now with the 200-day moving average. You can see in the last year, we only came close to it right there. If we zoom out on a 5-year basis, you'll see how important this level is. So here's a 5-year chart. Sorry how busy it is, but notice back in here, we came back down, we captured it and became support. Never really touched it again until right here. Battled with it for a good 3 months and then finally lost it. And we have a 27% decline there in 2022. Since then, it's been really, really good support. So it makes perfect sense that we'd get a bounce off of that. I think that odds are not small that we go back and retest it and ultimately lose the 200-day based on everything that's going on in the world. Does not mean it's going to happen. I'm just talking about odds or probabilities, if you will. As for the momentum indicators, at least on the daily chart, you still have a very bearish look. There's nothing that looks too good here to me. Just almost oversold, and again, the 200-day moving average pretty much explains today's action so far. As for the NASDAQ 100 index, same thing. I think it was this one that I said there just didn't seem like there was any support. And sure enough, it didn't find any in any serious, meaningful way until we got to the 200-day moving average. But now the NASDAQ 100 is rolling back over. And so there's that support right there at that 200-day moving average. So let's just do the same thing really quick. Go back 5 years, and you can go back 50 years, and you'll see what I mean. Here we lost it. This was a 37% decline for this particular index, which is where the big tech stocks are trading. But you can see, finally recaptured it, tested it, support today so far. Breaks that, things are going to get ugly if it breaks it with momentum, and then suddenly it becomes resistance. The dollar's been very interesting. Here we're having tariffs, and the knee-jerk reaction or the knee-jerk thought is that the dollar will go up because the currencies of the countries we are throwing tariffs on will go down. Well, I've been saying for quite some time now that in a risk-off period, it's the yen that will do the best, and that is the case as we speak here today, and we do have a position in the yen in our core portfolio for that reason. The dollar index itself, the number one currency that it's weighted against is the euro, the number two is the yen, and we don't have tariffs there yet. Now, the Mexican peso, for example, was tanking pretty good earlier today. But what's broken down, though, is the correlation between a weaker dollar and a rising stock market. That hasn't been the case. And by the way, you can see it played out to this bear flag perfectly right where it is today. So why would the dollar be getting weaker in this environment? Well, yields, for one, have been reacting. Save for today, yields have spiked in the other direction. But for the most part, yields have been coming down. I'll show you that in a second. And that lessens the interest rate differential advantage of the dollar. Now, why would yields be coming down with the dollar? Well, that would be because suddenly the concern has flipped. No longer to we want a weak economy because the Fed's going to cut, and now we're getting a weak economy. Maybe we're going to have a recession. And maybe these earnings estimates for U.S. stocks are way out of whack, which they 100% are in a recession scenario. As for the yield, as I mentioned, you can see we're getting a pop today, but wow, what a decline in the yield. That speaks ill of economic prospects, right? That would be people buying bonds for protection and forcing yields lower, anticipating that yields are going to be going down going forward because of economic weakness. And then lastly, our friend gold has seen a pretty good pop. If you remember, I was getting concerned. We hedged our position here a little bit. Gold's an important position to us. This, again, technically, gold is suspect to me. With all the uncertainty, you'd think it'd be getting bought with both fists like it has been for much of today. But, it wouldn't surprise me if we saw some more weakness there. But of course, that remains to be seen. We are long-term bulls on gold, I think, for all the right reasons. So folks, I am just going to do a hard stop right there. I hope that was helpful to help you understand what's going on right now. Expect more of the same, intense volatility in both directions. The administration does seem to be digging in their heels on tariffs this time around, and we're not getting the kind of backing away from them based on what the market's doing. And from what I understand, I didn't hear him say it, but the Treasury Secretary implied that they're not even thinking about the stock market right now, that they've got bigger fish to fry, and kind of so what if the market goes down. I do think there's a pain point for them, but apparently it's not at the levels that we've seen it drop to so far, which really are just, for the NASDAQ, just barely in correction territory. So folks, while this may feel awful, this is nothing in the long-term scheme of things. I've been doing this 40 years, and this is just a blip that is just not even on the long-term charts in terms of volatility. I mean, this is the kind of event you'd expect every few months anyway. But yes, from a macro perspective, from a geopolitical perspective, from a technical perspective, we need to stay on our toes right here. And I'll say it again, expect a lot of volatility as we move forward. Folks, thank you as always for watching and listening. Have a great rest of the week, and I'll be back at you by the weekend. Take care. Bye-bye.